Hey, it's Tom here and welcome back to the channel. So in this video I want to talk about investing myths. For people that are just getting started investing, whether it be in real estate or the stock market, I think it can often be quite an intimidating world. There's a lot of jargon, a lot of people who sort of pretend to know a lot more than many others, and there's a whole bunch of myths and half-truths kind of out there in the investing world. So in this video I want to give you my top 5 investing myths, starting right from the fact that you really don't need to be some super rich, highly educated person to get started with investing, right through to a whole bunch of myths that I see even experienced investors kind of buy into. So that is the topic of this video, but before we get into that, we do have a sponsor, and today's video sponsor is Hatch. Now, Hatch have been my personal broker of choice for me as a Kiwi here in New Zealand doing all of my US investing. Now, I originally switched across to Hatch about 2 years ago at this point, basically to save on fees. I was paying $90 a trade with one of the big banks, which I can now do that same trade in Hatch for as little as $3. So it's been a massive money saver, and a whole bunch of Kiwis have been switching across to Hatch or getting started investing with Hatch over the past couple of years, and they have actually recently hit a milestone of 100,000 investors here in New Zealand and over $1 billion invested. So incredible story for Hatch, and it's a fantastic platform that continues to get better and better. In recent months they have actually launched kids accounts, so you can get investment accounts and portfolios set up for your kids and start that sort of compound growth curve really early, which I think is fantastic. So if you're interested in getting started with Hatch, you will need to head to the link hatch.as/investingwithtom. If you head to that link, sign up and start a new Hatch account, deposit 100 New Zealand dollars into that account, you'll get a free $20 top up from Hatch so that you can get started investing with a little bit more money. Okay, so the first investing myth that I want to talk about in this video is that investing is really complicated. You need some finance degree to even get started in investing. That to me is a total myth, and it's completely untrue. Some of the best investment strategies ever are extremely simple, and they're quite elegant in that way. So let me give you a couple of examples of very simple investment strategies that have worked well over a long period of time. The first and most obvious that comes to mind for me is just investing in the market broadly. So when you invest in the stock market, basically it's a collection of a whole bunch of individual companies, and if you buy shares in those companies, which is what you're buying when you buy into the stock market, you're buying small pieces of ownership of all of those different businesses. And one of the more popular ways of investing in the stock market today is through investing in things like exchange traded funds, ETFs, or index funds. Now these are basically investments where you can buy just the market broadly. You don't have to go out and pick individual companies, you can just buy all of them, and over a long period of time that has given about an 8 to 10% return per year on average throughout a long sort of investment time horizon, depending on which country's stock market you tend to look at. So that is a very simple investment strategy, is just continuing to buy into the broad market over time, and that's an option that a lot of people have lent towards, particularly in more recent years. And even probably the greatest stock market investor of all time, Warren Buffett, really has a very simple strategy as well. Now of course Warren Buffett is an absolute genius and has much more intricate kind of strategies kind of that fall within this broad discipline that I'm sure he has made a lot of money on as well. But fundamentally Warren Buffett is a value investor, so he is someone that picks individual companies, unlike just an ETF or index investor who buys the broad market. But Warren Buffett is doing it in quite a simple way. Basically, he will only buy into one of those individual companies if he thinks that he's getting more value than what he's paying for. In other words, if the current share price of a business like Apple, for example, is $100, but he believes that Apple fundamentally, based on the cash that it generates within its business, is worth, say, $200 per share, that's a position where Warren Buffett will be willing to buy into that company. So he's treating stocks like truly the businesses that they are. He's pricing them based on what he thinks a private buyer and seller that are kind of rationally understanding that business. He's buying them at prices less than what he thinks those two people might decide on, just like he might buy into a real estate deal down the street, where he's looking at what price do I pay for that real estate, what kind of return do I get from my rental income, and is that an intelligent deal? And that is a very simple strategy as well. So it really doesn't have to be super complicated. You don't have to have the world's highest IQ, and you don't have to have 500 different business degrees in order to get started with investing. Okay, so the second investing myth sort of flows on from the first one, and that is this idea that you have to pay a professional money manager in order to do well in the stock market in particular. So you have to buy into some sort of actively managed fund. On TV here in New Zealand, I often see these ads for actively managed funds, and they're talking about, your money's going to be working harder for you because it's active, and you've got the smartest people in the room making good decisions about what to do with your money. And basically, I think that's a complete myth. I think that occasionally you will find an active manager that can generate higher returns than what a stock market index might, like we talked about in sort of the first investing myth, where you just buy a broad basket of stocks and buy the overall sort of index. I think every now and then you'll get a manager that can consistently outperform that market, but the research shows that over a long period of time, every sort of actively managed fund may have a good year and may have a bad year, and over a long period of time, they all sort of average out to about the average rate of return. So that might not sound so bad. Maybe that sounds pretty similar to investing in an index initially. If you put your money with an active manager, you'll have good years and bad years, but you'll probably do about the same on average as an index. And certainly that is what will probably tend to happen in the case of the returns that are initially generated. But the big downside that you get with actively managed funds is something called fees. Now, obviously, in order for an active manager to manage money as a full-time job, they have to be collecting some income, and that income basically comes from taking a small percentage of the money that you have invested every single year in order to fund their operations, in order to pay their expenses, pay their rent, pay their staff, and of course pay themselves as well. And these fees can actually make a surprisingly large difference in terms of the amount of money that you end up with at the end of an investment career. One of the classic fee structures for hedge funds in the US for a long period of time, and still even today in many cases, is this idea of 2 and 20, which basically means that they will take 2% of the assets under management simply for running their fund in order to fund their everyday expenses and so on, and then they will also take 20% of any profits. And that is a huge kind of weight on your compounding and your long-term investment results. So let's even forget about that 20% of profits kind of part. Let's just focus on the 2%. Let me put up an example here of, let's say that you were able to generate, say, an 8% return in an index. Now, this is what would happen if you put in $10,000 every single year for the next 40 years, how much you would have at the end. And let's take that same example of, again, contributing the same amount of money, but you're doing it through an active manager who charges a 2% fee. And let's say that on average, that active manager also gets about 8% per year. Well, if they then charge their 2% fee, you're actually really only ending up with about 6% per year, and you'll notice that the impact on the final number that you have at the end of that investment journey is absolutely enormous. So certainly, although there are some great active managers out there, and there are people that actually charge basically no management fees and performance fees only, Monish Prabrai, one of my favorite investors, being a good example of that. On average, over a long period of time, the actively managed fund industry is actually sort of detracting value from the long-term results of investors. Okay, the third myth is actually around stock market returns, and this is going to be an interesting one because this is one that even experienced investors tend to sometimes fall into, and that's basically this idea of the stock market returns about 8% per year. Maybe it's 6 to 10% is kind of the range, depending on which stock market you look at. And this isn't necessarily a myth, but it's a little bit of kind of a half-truth. So over an extended period of time, if you go back, say, 100 years in the New Zealand stock market, for example, you'll see that on average, the returns come out at about 10% per year compounded here in New Zealand. If you do that in the US, it's probably closer to 8%, and again, it will vary depending on which country and which stock market you're looking at. But the thing to understand with the stock market is it is extremely volatile, and you're not going to get consistently that 6 to 10% return per year. It's just not going to happen. I will put up a chart of annual returns here from the S&P 500 index, which of course is the largest stock market index over in the United States. And you'll notice that returns are very, very volatile. You'll see in 2008 and 2009, there were some massively negative years. And you'll see that in the past couple of years, there have been some, really positive years that have done far better than the 8 to 10% per year. So maybe that's what you can expect over a long period of time, is that 6 to 10 or 8 to 10% return per year. But it's going to be a very bumpy ride. And this is one of the core arguments that a lot of people have for why you should be contributing to your stock market investments consistently, and not necessarily just putting in a big whack of money all at one time. Certainly that's a strategy that can work well, but in order to avoid a lot of these fluctuations and not accidentally buy right at the top of the market when it's about to go down, as much as 50%, for example, buying in consistently and getting an average price over a long period of time can be a really powerful tool. Okay, so stock market myth number 4 is that you can't beat the market. You can't generate a higher return than the stock market index or the stock market average. And that may sound kind of weird, because I've just said earlier in this video that active managers generally can't beat the market. On average, they all do average. And that's of course the case. You can't all be in the top 50% and you can't all be in the bottom 50%. On average, everyone has to do average. But I would argue that those that can apply a sound investment strategy can actually have quite a significant edge in the stock market. And that strategy, for me personally, really aligns with what Warren Buffett is doing. He's looking to identify businesses that he can understand and value, and then only buy into them when he is able to buy those businesses at substantially less than their intrinsic value. And there are basically two schools of thought here. So there are the people that fall into something called the efficient market hypothesis, which basically says that all publicly available information about a stock is already built into the price of that stock. And therefore, basically researching individual companies and trying to buy them below intrinsic value really is a complete waste of time. They think you can't do it because they think that all the information about that particular stock is priced into that business. But there are several examples of where that's really just not the case. And one of the coolest examples that I found is actually a presentation that Warren Buffett did called The Super Investors of Graham and Doddsville. Now, the statisticians and the academics basically try and explain Warren Buffett's personal investment track record, which is just spectacular. He's beaten the market over an extended period of time. They try and explain his track record as a statistical anomaly. They say that if you have enough people flipping coins, enough monkeys flipping coins, eventually one of them will land 100 heads in a row, right? So they think that basically Warren Buffett has just gotten lucky. That's kind of the academic efficient market hypothesis crew's sort of explanation for what Buffett has done. So what Warren Buffett did as sort of his rebuttal to that theory from the efficient market hypothesis crew was to basically say, maybe I am just lucky. Maybe I am a monkey that continues to flip coins and get heads every time. But what would it mean if all the monkeys that were happening to, get all these really good returns and flipping heads over and over again, what would it mean if all those monkeys came from the same zoo? And he basically did this talk and said that pretty much all of the students of his original teacher, Warren Buffett's original teacher, Ben Graham, they all had these great performance track records. And he argued that they were able to achieve those track records because they were following the sound investment strategy of trying to buy businesses for less than what they're worth. They weren't caught up in trying to have a good quarter or a good year, or worrying about speculating on what's going to happen with interest rates, or some high level big macroeconomic kind of issue. Rather, they were focused on individual businesses. They didn't really care what their performance track records looked like in the short term, because they knew that if they bought good businesses at really attractive prices, they would probably come out the other end of that okay. And that's one of the most famous speeches that Warren Buffett has ever given, is that Super Investors of Graham and Doddsville. And it's a fantastic argument to say that you can in fact beat the market if you do have a sound investment strategy and apply that over a long period of time. Okay, so the fifth and final investment myth that I want to cover in this video is one of the things that I hear just all the time, and it's a massive pet peeve of mine, to be perfectly honest with you, and that's this idea that you should only invest what you can afford to lose. And that to me really is sort of a gambling mentality in the stock market. And if you're going in with that particular perceived idea, I really think you're probably going to make some pretty unusual and pretty high risk investments. You're probably going to be speculating and gambling essentially on companies that are maybe unlikely to do well, that are really highly priced. And companies that you think, can just explode in price on the short term and make you really good money. And in a lot of ways, you're sort of thinking about it like you might if you were going to the casino. But for me, investing is simply the idea of doing largely what Warren Buffett does, of trying to make investments in good businesses at reasonable prices and doing that over a long period of time. And if you can buy a basket of good businesses, just like you might be able to buy, a handful of rental properties in your neighborhood over an investment career, you're not going to be investing only money you can afford to lose in that situation. You're going to be investing probably quite a significant portion of your life savings, and you really need those investments to be persistent, to still be there, when you reach retirement and so on, and still be there 10, 20, 30 years from today. So if you're only investing money that you can afford to lose, I think you're probably going in with the wrong mentality. And frankly, the chances that you're going to lose all your money in the stock market if you have a diversified basket of businesses is near on impossible. If you buy into an index fund like we talked about towards the start of the video, like say an S&P 500 just as an example, that has 500 different businesses in it. So in order for that investment to go to $0, that would mean all 500 of those companies would need to go bankrupt. And even then, you actually probably wouldn't go to zero, because what happens in an S&P 500 is if one of those 500 companies performs really poorly, it will actually get replaced with a new company. So you can have companies in there actually go bankrupt and they get replaced with new ones, and you still have 500 in that overall basket. So if we ever do get to a situation where the biggest 500 public companies in the US all go bankrupt, I'm going to hazard a guess that the world is in probably much scarier situations, and you're going to be much more concerned with what's going on worldwide than what's going on with your investments. If that were to ever happen, that would just get absolutely crazy, and I think it's pretty much impossible. So, if you're investing in the right way, you can really afford to invest a lot more money than you can afford to lose. I think that's just a bad mindset to have in general going into this sort of thing. So those are my top 5 myths in terms of investing. I do hope you enjoyed the video. If you've got any myths you think I missed, feel free to drop them down in the comments below. I would love to hear that from you as well. If you're interested in the Hatch offer, feel free to go to the link hatch.as/investingwithtom. But that's it from me today, and I will see you in the next one. Cheers.